What's good on team? Welcome back to the channel. Today we're going to be talking about what are options and how to trade options as a complete beginner. I'm going to be explaining you guys how options work and what is the difference with options compared to shares. I know it's a confusing topic and it's overwhelming when you're first starting, but I promise you it's really not that bad understanding options. Before we get into the video, as always, subscribe down below. Go check out all our other YouTube videos that we have, a lot of great educational content. And if you want to join the community of traders, feel free to check out our Discord. The link will be always in the description below. So first of all, what is an option? So all an option is a contract between buyer and a seller. So whoever owns the option can execute the option and buy X amount of shares at that given price. So you can see why somebody might want to buy a contract. If the contract says, hey, you can buy 100 shares of Apple for $50, there'll be, if Apple's $130 today, that's a huge discount. So you can see why contracts can be so valuable. But that's all the options are. It's just a contract. It gives you the option of buying the shares at a given price, wherever the contract price says, but you don't have to. So the contract, even if you have it and the expiration date on the contract expires, you don't have to buy the shares. So now we're going to be talking about what are the key characteristics of options. Well, one of the first big difference between shares and an option is that they have an expiration date. So the contract can technically expire. So why is that important? Now we're going to go and show you guys how an option chart will look like. This is with Thinkorswim, and depending on the broker, it might look a little different, but everything will usually stay the same. So as you guys can see, there is a date right in the middle, and that's going to be the expiration date that we're talking about. So if you bought this contract right here, it will expire on 12th of February. So why is that important? If the contract expires, the day after expiration, it's not going to be valid anymore. So a lot of times, you buy a contract depending on how far or how long you think the stock is going to go up or down in price. So unlike shares that you can technically hold forever, contracts you cannot, because they do expire. So you gotta be very careful when you're choosing a contract, the expiration date. It's a very key component of contracts, choosing the right expiration date, because a lot of rookies might not know that and they might buy the wrong expiration date and they might end up getting a contract that expires. The next key component of contract is called the strike price. As you guys can see up here, there is something called the strike price. So the strike price is the underlying price of what we think the contract is going to be. So let's say I choose a contract that's on the 12th February, then we go down to strike price and we see all these numbers. So I'm saying that the shares on the contract are going to be $100, $101, $102. So that means I can buy 100 shares for $100, $101, $102. That's all the strike price is, the underlying price on the contract for the shares. So combining that with the expiration date, that's how you get to choose which contract you should be buying. Another thing that is key component on options is understanding how the options actually cost. Because you might go on, let's say you want this 12th February right here, we're on 12th February, and you want this 100 strike on 12th February. So you might see that's only 8.8 right there, and you might think, oh wow, that's really cheap. I can get 100 shares for $100 of Chewy for only $8.80. If I sell that, it's going to be a huge profit because Chewy is $106 right now. But actually, you have to multiply this number by 100. With every option, you're going to have to multiply the number by 100. So if you take 8 times 8.8 and you multiply that by 100, it's going to cost you $880. So that's how much the contract will actually cost you. It's called the option cost multiplier. Every single time you see the bid or the ask, which is the range between the prices of the contracts you can get, you're gonna have to multiply by 100 to get the true value of the contract. So that's a real big component, and it's a little math that you're gonna have to do in your head, but it's really not too bad once you get used to it. So what is the risk of options? If anybody can just buy a contract and no real risk, just buy it, and if the stock, is going to be cheaper than the contracts or more expensive, you can buy it or just get rid of it. Well, that's something that we call the premium. So the premium is what you pay upfront for the contract. So this number that we just talked about, this $880 that you will pay upfront, that's your premium. So let's say you buy it, and then the day that the expiration expires, the contract, you don't want to execute it, and you want to just let it expire worthless, and you didn't sell it, that's how much you would lose. You would lose $880. The best way you can do this as an example is imagine you have a house, and this house costs $200,000. I could offer you a contract saying, hey, I have 1 year time, so my contract expires in 1 year, to buy this house at $200,000, and I will give you $10,000 upfront just for the ability to have this contract, right? So let's say I give you $10,000 upfront for having this contract that says I can buy this house for $200,000 within a year. Let's say the year passes and the house now costs $300,000. So obviously I could buy the house for $200,000 still and profit $100,000 minus my premium, which is what I paid up front. I would total profit of $900,000. So that's where the premium comes in. That it's giving you're pretty much paying to have this contract that can give you the ability to be very beneficial. So that's where the premium comes in. But now let's say the house that you just bought, or that you bought a contract for, rather than going up to $300,000, it goes down to $100,000. Now, am I gonna execute a contract of buying this house for $200,000? Well, no, because I will be losing $100,000. So I decide not to use this contract. I let it expire. I don't enforce the contract. All I'm gonna lose is this $10,000, which was the premium I gave the owner of the house to have the ability to hold this contract that says, hey, I can buy this house for $200,000. So the underlying risk is going to be your premium. And as we spoke before, the premium is going to be how much you pay upfront for the contract, which goes hand to hand with the contract multiplier. So depending on the number you see either on the bid and ask, you can multiply that by 100, and that's going to be what you're going to be paying upfront. Now we're going to put all this together for an example. So let's say we're trading stock CHWY, Chewy, and we think on February 19, 2021, the stock price will be over $110. So we choose the strike price of 110. And we think the stock price is gonna be 110 or more. So we choose the strike price of 110 on the 19th of February. And we're gonna play the premium of 4.55, multiply that times 100, times 100, and it's gonna equal to $455. So we bought the contract for $455. The shares of Chewy reached a total of $120 before our contract expires. So we have $110 that we can buy So we decide to execute our contract and buy the shares, and we will only have to buy the shares for $110. So we get a profit of $10 per share times 100, which would equate to $1,000. But our actual full profits would be this $1,000 minus the initial premium that we paid. Of $455, which equals to $545. So this is how a call option will work. If we were to execute it and the call option goes our way, the stock price is above what our strike price is, and everything goes according to plans. Now we're going to talk about some different details about options that you should know. One of the first things you gotta know that everyone talked about, there's two different types of option you can buy, and those are the puts, which would be pretty much saying you're betting the stock will go down, and those are the calls, which is pretty much saying you're betting that the stock's going to go up. Then we're going to need to talk about something called implied volatility. So implied volatility, all it means is that the stock is more volatile. So other than just trading in like a little tiny channel, it's actually trading much wider ranges. Goes up a lot, can go down a lot, and it moves a lot. So implied volatility usually will most likely affect options in a good way, in a way that if people that have implied volatility think that if it goes up a lot, your option will be worth a lot more. So it will most likely affect your options in a good way. So that's why premium on stocks that have high volatility, stocks like Tesla, they're traded a lot. Any stocks that moves, on big ranges will have high volatility, so it will most likely have a higher premium than if you're trading in standard channel. Stocks like that move less, like Coca-Cola, Apple, will have a lesser premium than those other stocks that have high volatility. So let's say there's a stock that's trading around this channel like this, and you buy around this level right here. The stock then goes all the way down to here, and let's say all the way down here, your contract is worth just 0.01. So this is your contract only worth 0.01 at the very latest until it's expired. And if your contract is out of the money and it's worth just a few pennies, you're better off just closing it off than letting it go expired, worthless. At least you can save yourself a couple dollars. Well, let's say it goes here and it's 0.001. Then anything below this level, let's say the stock, other than going back up, it just kept trending down, your stock will still be worth 0.01. So down this level, 0.01. Down this level, 0.01. Down this level, 0.01. Stock can go all the way down to being 0.01 pennies and still be 0.01 option worth. So that's why stocks that have low ranges have lower premiums, because they know that most likely the stock, if it tanks all the way down here, is not likely to move back up. So their volatility is very low. If it starts trending down, it will have a really, really hard time and very unlikely to go back up. But now let's say you're trading a stock, the other being on this nice easy range, has a range much bigger, let's say like this, then you're likely that, let's say you buy here and anything from under here all the way down is still going to be 0.01. The likely that you can go back up is much higher than a stock that tends to stay in a specific range and not really move out of it. So they know that even if it goes down, you have higher chances of end up in the profits anyway by the end of it. So the nice thing about that is that with options you have a cap on how much you can lose, which is your premium, and you technically have an uncapped, unlimited amount that you can win. And that's one of the things that really attracts people to options, is the ability to win as much as possible. Now another thing that I wanted to go over with options and how to trade them is that most of the times, I would say about maybe 99% of the times, you're not gonna exercise your option. Because let's say you needed to exercise your option, you had this 100 call here, so you need to exercise it and you need to multiply that by 100. That means that to exercise it and buy 100 shares for 100, you will need $10,000. And for a lot of people, a lot of beginner traders, they might not have that $10,000 or they might not want to. So 99% of the time, the premium will be higher and they will just sell this contract. Let's say they bought at 9.95 and the premium is now at 12.5. The premium now is 12.5. They would just sell the premium, so they will make the difference between 12.5 or 9.95. So most of the times, 9% of the times, you don't want to exercise your calls. There's really no need to, and you can make most of your plays just playing off the premium, selling the premium, because there's no real benefit of selling the shares unless you want to keep them and hold them past your expiration dates. That's the only time that I could see anybody wanting to keep them. If you're doing a long-term invest in something like Apple and you want to exercise it and keep those shares for as cheap as you got for maybe forever. So 99% of the time you're gonna be just selling your contract without exercising it and profiting off the premium. So it's whenever these numbers right here that you bought, it would have just gone up, you sell the contract to somebody else, and that person, they might exercise the contract or not. And fun fact about options is very highly traded by hedge funds. Hedge funds play with options a lot. They buy the contracts, hold them, and they execute the contract and keep the shares for just for the long-term hedge fund things that they do. But they have a much different story. They can afford spending a lot of money by hundreds of contracts and hundreds of shares, executing them at a certain time over time. So now we're going to go over a couple other things that you need to do about options. So with implied volatility, how do you calculate that in a price? So let's say, you bought the stock and the stock has stayed constant, the option stayed constant, but the premium is going down. It's most likely because the volatility is going down, and that's kind of hurting your premium. With higher volatility resolves to more inflated price because people are going to predict the stock is going to be more volatile, so it's going to be more people that want to buy it sooner, and that causes the premium going higher. So the stock stays constant, the volatility goes down, and your premium is going down. So it's all things that are kind of hard to calculate, and a really good resource that I like to recommend to people is option profit calculator. You can go on option profit calculator, optionprofitcalculator.com. Choose the kind of option that you chose. In this case, it's gonna be long bullish. So the really cool thing about the site is that you can put in every single thing you need for your call or your put or whatever type you traded, and it will calculate for you how much your option will be worth depending on the time decay. It can be overwhelming trying to do all the math in your head and see how much your options will be worth. So this is a great tool you can use. In this case, we put in Chewy, and automatically gives you the stock price, and it's an after hours, it's going to be moving. We bought it. The price per option, for our example, was 8.80 on this 12th February. Strike price of 100. Total cost is 880 our premium. The expiry price, we're gonna put the 12th, because that's what it is. Strike price 100. Implied volatility, you're gonna leave this blank, and it's gonna auto formulate for you. You're gonna leave this blank, and it's gonna auto formulate for you. You're gonna agree, and you're gonna calculate. And now you can see that it calculates how much your option will be worth depending on the date, just by looking at this chart. So, let's say by the 4th, which will be, or today, this after hours, the stock would have gone to $115. You would have been up, all the way up to $14.56. You would have been profiting. Let's say on the 10th, the stock hasn't moved much. You went from 100 or only to 103. You'll be up 20% or profiting $176. Now let's say it's the 11th, closer to expiration date, and actually the stock went down all the $99. Then you'll be down 43% or minus $379 after the premium. So you can use this great resource, Options Profit Calculator. You can use this great resource, Options Profit Calculator, to calculate your options worth. You don't have to do a whole lot of math, and it really helps you out, especially in those longer time frame plays that you can take a look at and take extra time after hours to see how much your options would be worth depending on different scenarios. So as always, guys, this is going to be a quick crash introductory course to options. In the next video, we're going to be talking about how to apply options a lot more in depth and how to actually go over real life examples, different stocks that we trade in Discord chat as well. As always, leave a like down below, and I'll see you guys all in the next one.